Good morning, everybody. Welcome to another episode of Self-Storage Made Simple podcast. My name is Russell Nersesov. I'll be your host. And today we have a very special guest, a good friend of mine, Frank DeSalvo. Good morning, friends. How are you?
Morning, Russell. Great to be here. Great to finally get the invite onto the podcast here.
Oh, yeah, for sure. Well, good to have you, man. Good to have you. So Frank is a Senior Director, Self-Storage Investment Sales at Franklin Street. I started the intro for you, bro, but if you can take a few moments to just tell us about what you do, where you come from, and take your time.
Yeah, absolutely. So as Russell mentioned, I head up investment sales for self-storage at Franklin Street. I'm originally from Naples, Florida, so I grew up in Florida, went to school in Boston, spent some time in New York, where I originally got into real estate. Started my journey in self-storage with a family office up in Manhattan, where we were buying and developing value-add self-storage facilities throughout the Southeast. So while I was there, we were going direct to owner, establishing those relationships, doing a lot of value-add development. So finding 30 or 40,000 square feet of existing with additional 2 to 3 acres, and then building those facilities up to institutional size. We built up a portfolio of about 12 to 13 assets. We sold the majority of those at the end of 2019, at which point I decided I wanted to get into brokerage. So I've been a self-storage broker ever since that time period.
Awesome. Cool story, man. So you've been around for a while. And the first question that I want to ask is the question that I usually ask all of our guests is, what is your view of the market today, as we sit here today? Give me a 20,000 feet market overview, if you would.
Okay, so it's August 30th, 2023. I'm saying the date because I think when you ask most people in the brokerage space, in the acquisition space, and the debt space right now, we are in a quickly changing market. And a lot of people say, hey, the market's changing week to week. So it is very challenging this year to try and string together deals, to try and meet expectations in terms of what sellers want versus what buyers can pay, and more importantly, what banks are willing to lend on. We're starting to see LTVs go from what was the norm last year, maybe 75 to 80%. Most people are saying, depending on who you ask, 60 or below. I've been working with some groups recently that are getting more comfortable underwriting at 50% LTV.
Yeah.
So what that's going to do is, it's going to diminish your return on equity, your cash on cash right off the bat. Interest rates have gone, again, from this time last year, we were in the fives or, 5.5s. Most groups that I talk to are now underwriting to north of 8%. So we're seeing hundreds of basis points go up here in a time period, and banks are not as interested in putting money into the market right now, right? We're working with a lot of different groups who are saying, yeah, I can give you this money, but it's got to be at all of these terms, and finding the deals that check all of those boxes is very challenging. To add one other thing, I think another important note here that we're seeing in the market is the consumer fundamentals are starting to be affected. And a lot of major markets that have been hot for a long period of time, if these markets have had 10, 20% year over year increases in rent growth, the inflationary measures that the Fed is taking is having an effect on the consumer base of self-storage, meaning that people are not willing to pay 10% year over year. A lot of bigger groups are seeing decreases in occupancy right now. So it's a little bit of a perfect storm where you have these higher borrowing costs, not as many banks willing to go to the market for self-storage. And then on top of that, on the underwriting side, we can't project the same level of rent growth, if any, for the first year or two. Right. So it's an interesting time.
But to be frank, I mean, the rent up that we experienced in the 2021, 22 in terms of the rates increases, yes, the rates came down somewhat, but they still higher than pre-pandemic, wouldn't you say?
They are. I would agree with that. I think the key thing to take away here, though, is people got used to paying, prices based on that rent growth and that rent continuing to go up. So if it's starting to come down, like any, capital market, when you have that opportunity to push price based on that projection, now it's starting to come down, and a lot of groups are not hitting their pro formas based on that. Hey, this, Nashville market or the Charlotte market's going to keep going up year over year 10%. We're just not seeing that this year. So I agree with you. It is higher, but people got used to paying higher prices for the opportunity to continue to push rents.
So what do you think is happening right now in terms of the debt availability and the banking industry in general? When you said that the debt is no longer or might not be as readily available as it used to be within the last 5-10 years, but is it across the board, or the debt is still available for the prime location in the primary market, secondary strong markets?
I think debt is still available for primary locations. I think for smaller locations, it's getting tougher and tougher to get financing for those types of deals. I think if you have, the other thing that I would say is if you have pre-existing relationships or accounts open with banks, going back to existing customers is easy. A lot of banks are not opening up to new customers right now. We've seen this time and time again where people are trying to push into new markets or whatever it might be. It's a tough time to open up into a new market. And that's why we've seen buyers kind of snap back to, all right, well, we own 3 or 4 facilities here. There's going to be those management efficiencies, but the bank is also going to be able to believe in them as a client, and then also, have that proof of concept that they can operate in this market. So I think that speculation that banks and buyers were comfortable with when interest rates were very low, that has gone the other way, where they're not really comfortable with much, if any, speculation anymore. So yeah, I think debt is still out there. I think it's becoming less and less available. And I think, in my opinion, over the course of, a rapidly shifting market, which is what we've had for about the past year now, I think we're currently at the most difficult point in the past year, where interest rates are the highest, banks are becoming the least interested in lending, and interest rates just continue to go up. If we were talking with buyers or banks 6 months ago, their interest rates were still sub 7. Now most groups are at 7 3/4 or above 8.
So let me ask you a question then. Who's buying? Who's buying then? Who's in a position to buy? Who is growing? Who's buying right now? Who's taking down projects right now? And what type of projects are being purchased right now?
Yeah, that's a great question. I think we're still seeing some cash buyers, some 1031 people that have sold maybe 6 months ago or 3 months ago or whatever it might be, and they're still in the market. We're still seeing interest from larger institutional groups. Pricing expectations have changed. REITs are still out there. They're still buying facilities. But again, the criteria has tightened from all of those larger groups, in my opinion. I think, going into a speculative secondary, tertiary location is much tougher for them to sell right now. So I think everybody's still looking, and groups are still finding, opportunities. But I would say, for the most part, brokerage shops and acquisition groups, transaction volume is down, right? A lot is most of it is not making sense in the market, and you're finding those opportunities. Some of them, are getting through the cracks. And I think the key right now for brokers and for anybody in acquisitions direct is to be underwriting as much as possible, to be looking at as much as possible, to be putting in as many offers as possible. And then you're getting that 5 to 10% success ratio. We don't know, when we bring a property to market, every time whether the seller is going to entertain seller financing or whether they'll consider it. By the end of the process, we've uncovered that quite a bit more when sellers start to see, all right, well, this is the difference in value. So you kind of asked me where are the deals getting done. We're starting to get a lot of deals done through seller financing for the deals that, can warrant seller financing. We've gotten some deals done through the SBA. They're able to underwrite more towards pro forma values versus current in-place values. And then we're getting some deals done with larger institutional groups that have capital that can kind of lease up or, follow them to we talked about these metrics, 8% or 8.5% yield on cost year 2, year 3, where it doesn't need to necessarily be, positive leverage right off the bat, because it's tough if debt's at 8%. It's a tough conversation with sellers to say, hey, your property was worth a 5 cap last year or 5.5 cap. Now it's got to be an 8.5 cap, right? That's 300 basis point spread in a market where in a lot
That's a huge difference.
Right.
Huge.
Right. And in a market where a lot of rents are now going down, right? So they may be losing income and their cap rate is expanding rapidly.
The double whammy.
Yeah.
Okay, well, we talked about the challenges, and I believe you're right on point. Myself and my group, Safe Storage USA, we are in the market daily. We're looking to buy, we're looking to expand. It's just really difficult today to make the numbers work for you, and we face a lot of those challenges that you described. But as we all know, when there is a chaos, there is an opportunity. When there's a blood on the street, I don't know if I can call it a blood on the street just yet in self-storage. I think the asset is still performing very well, and I think there's a lot of groups are trying to get into, and existing groups trying to expand. But where you see the biggest opportunities today, considering all the challenges that we talked about so far?
Yeah. I think what's interesting is when I got into self-storage, this was 2016, the average cap rates for deals, attractive deals were around 6.5 to maybe 7%. Some really good deals were around 6%. So now that we're seeing these cap rates go up 8.5% based on a function of where debt is right now, we're starting to see some really good basis plays, meaning that these properties that really should be trading for $70 or $80 a foot are now trading for $40, $50 a foot based on where debt is right now and getting that property to cash flow. But assuming debt does come back down, maybe not next year, but at some point in the foreseeable future, let's say within a 5-year term on a loan you would take out now, I think there's starting to be some really good value in that space. So one thing that we're really focusing in on is, all right, where are rents in your market? What's the dollar per square foot? And if that dollar per square foot is significantly lower than where the rents are in your market on basically a 1-to-1 ratio for a 10 by 10, I think that's a pretty good deal. Maybe not based on where debt is immediately right now, but in the future, I think that's something that I'm looking for. These higher basis deals that are in, your $150, $200 a foot, there's still buyers out there for that. It's a little bit tougher for the individual or the smaller group to wrap their head around. And I would fall into that same category, somebody that's going in and saying, hey, is this a good deal? If I'm paying $150, $200 and rents are starting to go down a little bit in that market, that's a little bit of a red flag for me. So
right.
I think anything that you can start to buy now below construction cost or below where even like a normalized construction cost would be, is going to be a good opportunity.
Well, a lot of people watching the podcast are the first-time buyers and the new investors into the space. And what would you say to them? What market to pay attention to, and where would it be easier for them to get a foot in the door and take down their first or second deal? What do you think?
Yeah, I think that's a great question. I really like, for the first-time investor, I really like kind of that mid-sized deal. I think some first-time investors go the route of, hey, I'm going to buy a really small deal. And that can work for people, and I've seen it work for people. The one warning I would say there is sometimes when you buy a really small deal, call it sub $1 million, your margins are going to be so thin that if you make a mistake or if your projections don't hit, you have a lot of fixed expenses there that are still going to need to carry that. So I really like that $1 to $2.5, $3 million space. I think at 2.5 to 3, you start to compete with some bigger groups. But if you're between 1 and 2, 2.5, then you're kind of in this space where you're probably not competing with any REITs. You're probably not competing with many private equity groups. So you have less competition in that space, but you have a big enough facility where it's going to at least comfortably carry your bottom line expenses. The markets that I like right now are kind of those secondary fringe markets, if you're 30 or 45 minutes outside of a major metro or even outside of a major secondary market. I think, I didn't mention this in the beginning. I'm based in Charlotte, North Carolina. Charlotte has seen tremendous growth over the past 5 years. I think many of the markets in North Carolina have seen tremendous growth. One thing that I would say is probably come up on the podcast before, but familiarize yourself with how taxes work in each of the states that you're looking at. Familiarize yourself with what is going on in insurance right now. We just had another hurricane hit Florida. The insurance industry is still reeling from the last hurricane that really hit Florida. We've seen premiums double, in some cases triple, on properties that are close to the coast there. So this is a pass-through expense business. You have to be familiar with what's happening in your local area. One thing that we've noticed in North Carolina, it's a tax-forgiving state, meaning if you're buying a multi-million-dollar piece of property, up to this point, North Carolina has been pretty forgiving on reassessing your property and having that tax bill be not something that's going to end up killing the deal. Tennessee, Alabama, we've seen similar things there. So
what are the states to stay away from in terms of taxes and insurances? What are the states that are more difficult to work with?
With every state, there's going to be two sides, right? So if there is, a more aggressive, tax reassessment, it's usually for a reason. There's more aggressive rent growth. But where we've seen taxes get very aggressive are in Texas and Florida and then South Carolina at this point of sale reassessment. I'm more familiar with the Southeast, but Ohio's been tricky. We've done a few deals there recently. Ohio as an interesting thing where they tie the reassessment to the school board. So, but yeah, I would really, and then, I think we're seeing a snapback to fundamentals. I think the idea of buying a self-storage deal in a random market that you don't have any connection with or haven't researched a good amount, when the economy's great, a lot of things work. We're going into a shift now. So I would really recommend people that are, they have a familiarity with the market. I think you can still be a out-of-state storage investor. I think that's very doable. You guys do that. But understanding the market a little bit more and understanding who the players are, where your exits are, where your rent growth is, where the industries in that market. That way you really understand kind of what you're getting into, because I think we're going to be in a period of time here, at least for the next couple of years, where if you want to refi or you want to sell, you're going to have to show that your property is performing on paper, not, hey, it could be performing. Correct. Which is what we've been coming out of over the past 2 years.
Correct. So as things are changing for sure, and me being in the market, you being in the market daily, we feel it, we know it. But for someone who wants to get into the business, what would you say? What makes a good market? What makes a market a good market? What are the traits that you would say? Like you already mentioned, you want to be 20, 25 minutes, half hour away from a strong secondary market. But what else? What other criteria do you recommend the first-time buyers, first-time investors to look for? In terms of maybe demographic, in terms of growth, in terms of any other aspect that you want to cover?
Yeah. So this is a little tricky because it's relative to wherever you are across the country. I think you can make a middle of nowhere tertiary market really successful for you if you're one of the only players in town and you can just continually raise rents and everybody's there. And we've seen this time and time again, and we've looked at this. But I think one of the big things to be looking for one, when you're going in to buy a deal, I think you want to understand right off the bat, am I looking to hold this for 5 years? Am I looking to hold this for 7 years? Or am I looking to hold this forever? And we've talked about this before, Russell. We're looking at different opportunities. If you're looking at a potential exit within 5 to 7 years, what you want to see is strong population growth. What I'd like to see, if it were me, is somebody else in the market that I would recognize from an institutional name, whether it be a private equity group, whether it be a REIT. I want to know that other people have identified those key metrics and there is a potential exit down the line. If I'm in a true tertiary market, I'm probably not going to see that. That's not to say I can't have success in that market. And that's not to say that I can't sell that property in that market down the line, but it's going to be a little bit more challenging. So I would say, just right off the bat, you want to see solid rent growth over the past 12 months, or at least that rent's staying the same. Now, that's a little bit trickier now just based on national trends, but I'd like to see that the rent is going up over time. I'd want to understand who are the key, what are the demand drivers here in this market, right? Is this a college town? Is this a vacation town? Is this, a town like Charlotte where it's mostly built on industry? Personally, then you kind of want to figure out what your risk profile is. If it's a town based on industry, that means that it's only going to go up so quickly, but it will be steady. And that's why Charlotte is kind of well positioned right now, is we're starting to see this kind of, snapback. Well, Charlotte has a bunch of jobs in the banking industry that continue to pay people a good amount of money.
Right, that's true.
It didn't go up speculatively over time, but it's not going to fall back in the same way. So I think you kind of want to determine your risk profile, but yeah, those are the things. I think you want to see a population. You want to see good square foot per capita. Most people look at that 7 to 8 as a national average. If you're well above that, that's a little bit of a red flag. I'm not saying that that's, projects can't work in that area. But I would say if you're at 20 square feet per capita, let's do a deeper dive and make sure that, there's something here that isn't being reflected in those numbers.
For sure.
Southeast markets.
Actually, I would love to do a deeper dive on that as a separate podcast, because I think you and I had some very major successes in the markets
on the square feet per capita.
Where the square feet per capita was not ideal. So maybe next time when we get together, we'll take a deeper dive into it.
Yeah. I think that's, just to touch on that briefly. I think where that metric can be somewhat flawed is, for one, it's different between non-climate and climate, and you can get those numbers. But what we've seen in a lot of markets recently is where occupancy is starting to suffer the most is in the smaller units. So your 5x5s, your 5x10s, maybe your 10x10s, we're starting to see pricing go down and demand go down. Whereas your 10x15s and 10x20s, they're staying full and there's a lot of demand there. So that square foot per capita is not necessarily going to be accurate, because it doesn't, not to say it's not going to be accurate, but it's not going to tell the whole story, because it's not going to go into which units are in most demand.
100%.
So
100%. One of those days we'll definitely take a deeper dive into the square foot per capita. I think it's a misjudged and misunderstood concept on some level, but
definitely.
So you gave a great advice for somebody who wants to just get into the business in terms of where to look, what to look for. We know the challenges. We know the problems that we're going through right now. However, I believe that the industry by itself still stands very strong, and it's a great time, and it's a great opportunity to get into business, especially if you're new investors. We can take hours. I feel that we can go over so many things. And Frank, thank you so much for coming in on the podcast and giving us so much value. Your experience is tremendous. You're in the trenches every day. You cover pretty vast amount of deals, and I follow your success, and I hopefully I'll continue to be a part of your story, and we'll continue to do many deals together. Frank, where can people find you if they need to reach out to you? What's the best way?
Yeah, so I can leave, I guess, something in the notes here, but Frank.DeSalvo, DESALVO @franklinst.com is my email address. Cell phone number is 239-293-3844. So those are probably the best ways to get in touch. I'm on LinkedIn as well, though. So if and I'm active, as Russell, as you know. So if you shoot me a message on LinkedIn, I'll get back to you. But I would say those are probably the best ways to get in touch.
Right, and we're gonna put it in the notes as well. All the ways that someone can reach out to you. Frank, I want to thank you once again, buddy, for an opportunity. It's an honor to have you. I love working with you. I'm looking forward to many successful deals in the future. And I want to thank everybody for coming in on the podcast and giving us your time. We'll continue to bring you industry leaders, and we'll continue to make it as simple as possible for you guys to start investing in self-storage, which I think is one of the best asset classes today in commercial real estate. Until the next time, see you soon, guys. Take care.